Atkins went rogue and declared that Ethereum, that thing Gary Gensler couldn't define without having an aneurysm, is not a security, just like Bitcoin. He went even further and implied that most tokens might not be securities either. So everyone gets a free pass? Well, he was responding to a question about companies copying Michael Saylor's playbook and loading up their balance sheets with either Bitcoin or Ethereum. Atkins played it coy, saying it's not his job to tell companies what to buy. But he was clear that it's encouraging to see the market embracing digital assets. All right, we're bringing James back. James, the SEC chair just said Ethereum isn't a security. How big of a deal is that, and what does that change going forward?
Yeah, I mean, it's nice to see like an SEC chair actually give an answer. Like we could play clips of Gensler sitting in front of Congress, in front of anyone of any substance, asking him questions about what is security, what isn't security, and he just danced around the question left and right. For the most part, from my point of view, something I've been saying for a long time, I did not view Ethereum as a security. I thought it was a kind of a witch hunt that the SEC went on. Up until they basically approved the Ethereum ETFs, they were trying to, they were sending out Wells notices. They were trying to interview people, sending out subpoenas, trying to basically say that the merge when Ethereum went from proof of work to proof of stake might have made Ethereum a security. They went after Joe Lubin. They went after pretty much everyone involved in the space. And I think what happened was the SEC realized they couldn't do, there was nothing they could do. So from my point of view, when they approved the Ethereum ETF, that was the nail in the coffin that Ethereum was not a security. It was a commodity. Gensler liked to say that some things could be a security in some instances and commodities in others and refused to give it up. But from my point of view, this is just saying what the market has already accepted. Ethereum was not a security. It hasn't been a security. I know there's a lot of Bitcoin maxis that don't like to hear that. My personal view is it likely would have been considered security when it went through its ICO initial coin offering. But it has since become decentralized enough in the way that it operates. I don't view it as a security personally. And I think it's a good thing the SEC views it that way. The other thing I would add that the SEC is working on right now is something that we would, in the ETF world, refer to as generic listing standards. Basically, it's a framework and rules around like what assets can go into an ETF wrapper and what requirements are needed to fit into an ETF wrapper. And that's something that we know for a fact the SEC is working on right now that'll be critical to determining what ETFs are going to come to market in the coming months, or basically what assets are going to make it into the ETF wrapper in the coming months.
Mm-hmm. And Atkins even went a step further as he also hinted that most crypto tokens might not be securities after all. Do you think that this signals a real shift in how the SEC plans to regulate the space moving forward?
I think this is the right way they should be doing. I mean, Hester Peirce has written a lot of dissents from the way that the Gensler and Biden admin was handling the space. They basically went well beyond what the SEC's jurisdiction was. This is something that Gensler did when he was at other agencies. He kind of pushes the envelope way beyond where his powers may have been. I mean, they went through regulation via enforcement. They were just, in many cases, they were arguing like different versions of the same lawsuits in different jurisdictions to see which ones would stick. Like, it's just not the way that a regulator should operate. So I think that that's correct. Most of these tokens are not going to be securities. Are most of them going to be valuable tokens? Or most of them going to be valuable protocols? Probably not. I think 95+% of the protocols out there are probably going to be worthless. But that doesn't mean that they are securities, and the SEC should be regulating them like securities. And I think that's what's going to come out of that framework I was talking about. They're going to dictate what can go into ETF wrapper by basically saying this is how digital commodities are going to work, or digital assets are going to work, with as far as the SEC framework is going to be decided. So I think within the next year to 18 months, you're going to see, 50 to 100 different tokens put into an ETF wrapper that the SEC basically greenlights. And even things that they do deem to be a security in the DeFi world, those will be handled just like securities are, right? It's just a different wrapper. So even if things are deemed to be securities, it doesn't mean that they can't be invested in and the SEC can't allow them to exist. It's just like they have to go through a different framework. So I think that the way that Atkins is looking at this is the correct way to look at it. And it's kind of refreshing to hear things from him, and specifically from Hester Peirce, who seems to be pushing the envelope with her crypto task force and the way that this all should be handled from a regulatory point of view. The question is, are we just going to be sitting here with Atkins and Hester determining what the rules are and coming with ideas? Or are we actually going to get regulation via something like a Clarity Act that will make it law of the land. Whereas right now, so if Atkins and Hester are gone in 4 years from now, when we have a new president potentially, are we going to go back to basically the SEC and CFTC just coming with their own rules and changing what the prior administrations have done? We don't want that. We need a real clear clarity act, if you will.
Right. Well, it seems like at least we're headed in the right direction as opposed to years past. You mentioned we had Gensler, who couldn't seem to answer really anything for us or provide any type of clarity. But now we have this new framework that does seem to provide us some kind of clarity going forward. And do you feel like this new direction might open the door for more institutions to feel safe getting into Ethereum and other assets beyond Bitcoin moving forward?
I think institutions are chomping at the bit for the most part to kind of understand this space. They're all like testing things out on Ethereum L2s and Ethereum and Solana. They're looking to get involved with these other protocols, but for the most part, institutions and TradFi legacy firms, most of them basically discounted this over the last 7+ years, 8+ years. There were some exceptions like Fidelity, ironically, JP Morgan and others that have like built up, the institutional know-how to possibly play in this space. But there's a lot of banks and big institutions that just haven't done anything and are like, okay, we need to get up to speed. And it's just like, you can't just use your typical experts on how TradFi works to like incorporate DeFi systems. So I think it's going to bring in more institutional money. The one thing, if you look back, think before the Bitcoin ETFs were approved, if you look at institutional investors, advisors, the number one reason why they weren't investing in the space, whether that was Bitcoin or Ethereum, was because one, they didn't know how they could get exposure. So basically the number one thing they wanted was an ETF. But the real reason they weren't doing it was because there was no regulatory clarity. No one knew how this thing was going to be handled. Are they going to invest in this asset class and then the US government is going to try to shut it down in some way? Are they going to go and attack everyone building in the space? So everyone was sidelined. So as we get more and more regulatory clarity, as things get more stable and understood about how it's going to be handled by the government and different things like that, the SEC, regulators, CFTC, you name it, OCC, the Fed, like as that happens, you're ultimately going to see institutions be more willing, maybe not jump in with 2 feet, but at least dip a toe in trying to understand and put some money to work in the space.
Yeah, absolutely. I mean, we're definitely seeing a new phase of this kind of crypto ecosystem, specifically with legislations being passed. And, a big thing that people have always said about the crypto space is they always talk about the volatility, right? The volatility, it's too volatile. But with all of this recent talk around stable coins and clearer rules, do you think we're finally heading toward a more predictable crypto landscape than we've seen previously? I know like people say the halving cycles are somewhat predictable, but with this new legislations being passed, do you think things are going to finally start settling down? We might see Bitcoin specifically move more like a traditional asset class? Like, things are changing. What are you seeing going forward in terms of that, the crypto landscape and its predictability?
I mean, if you just look at Bitcoin specifically, and this is true of any asset, if basically the way I view it is a call option, a store value asset, right? That's the way I think of Bitcoin. There are some other things, the peer-to-peer cash payment system that we can get into, what it was originally built for. But basically the real way to think about it is like gold as a teenager. Like a teenager is volatile, right? But if you look over the last decade, on a long enough time frame, that volatility has been going down. The vol on that asset is going down and to the right. So that is just saying like there's more adoption. That's not saying it's not volatile. I don't think Bitcoin will ever be not volatile. So I think that's a good sign if you're expecting to become a store value asset. But I don't know that it's going to completely decrease the volatility. I mean, the way I think about it is essentially maybe those 4-year cycles aren't going to go away completely, but I think the amplitude on the percentage basis is probably going to go down a little bit as more and more bigger traditional stable players come into the market, these TradFi firms. But that's like saying, I mean, the stock market is still plenty volatile. I mean, look what happened in April of this year. I mean, we had the S&P 500 basically go down 20%. I mean, that's not to say that just because TradFi is here that things are going to go down, but are we going to see those 80% drawdowns? I don't think so. Probably not. I think those drawdowns and maybe even the upside isn't going to be quite as volatile and explosive as it has been, because people are likely going to be looking at this as, I'm going to have a 5-10% allocation, and that volatility, I'm going to trade around it. So when it goes up a ton, I might decrease my exposure. When it goes down a ton, I might increase my exposure, which theoretically over a long enough time frame, if people are viewing it that way as a portfolio asset, that again will also decrease the volatility. So I think volatility is going down. I think as we get more regulatory clarity, as we were just talking about, it's going to help decrease some of the volatility and explosiveness. But there's no way to know for sure. People have been saying since for more than just this cycle that the 4-year cycle is over. I'm not necessarily in the camp that the 4-year cycle is over, but I do think that it's likely that it's going to be more muted, particularly with the way that we're seeing all these treasury companies come to market. So right now, I think it's a bit of a flywheel to the upside. I think over some time period, whether it be months or years or maybe a decade, there is going to be some point where potentially some of these treasury companies start causing a flywheel effect to the downside. That's a risk that people need to be aware of. But yeah, I mean, overall, I think volatility is going to be coming down.
You mentioned the treasury companies. What are your thoughts on that right now? You have a lot of companies that are trying to use the Michael Saylor playbook, but they're not in anywhere near the same position as Strategy, who's been doing this now for 5 going on 6 years. Are you concerned at all that this could be a temporary bubble? Because if Bitcoin were to have a 20% drawback, like we've seen time and time again, a lot of these firms are going to be at a much lower price than they bought into. Does that concern you at all with this Bitcoin treasury strategy phenomenon that we've been seeing?
Yeah, so I think like I said, I think there is definitely some risks, particularly with, I mean, every day there's a new announcement of a firm adding Bitcoin or issuing debt to add Bitcoin to their balance sheet. Some of them are seeing massive pops in their share price. Some of them are actually seeing drops. It's also happening with Ethereum and Solana. I saw one for Dogecoin the other day. I mean, you name it, everyone's trying this playbook. Anything in crypto, anything in TradFi, there's bubbles that form. I think there's probably a bubble forming a bit in this space. I think it kind of echoes things. I know this is not at all the same exact sort of situation. Saylor has addressed this exact question, but it reminds me a little bit of GBTC, where there is potential for it. Everyone was like, the premium's going to persist forever, and that's the way they're viewing all of these treasury companies. But if you look at GBTC, that I was writing notes, I remember in 2018, basically saying that like this thing could trade at steep discounts and for the same reasons it's trading at a premium. And I can't tell you I've never gotten as much vitriol on Twitter as I did when I was talking about that, because everyone's like, the premium's only going up and all this stuff. So I think there are going to be a bunch of these names that trades at discounts. Does that mean that Saylor and other people are just going to buy them because it'll be a more efficient way to buy Bitcoin because it's trading at a discount in some way? Maybe. Should it trade at some level of premium, just like increasing earnings? Stocks don't just trade at what the value of the assets they hold. I could make that argument. Should it be trading at 2-3x the underlying value? I would argue probably not. So I don't know. There's probably it's a unique system. We're finding out how this is all going to work. So yeah, I think it's a risk. Do I think Saylor specifically and Strategy are going to run into tons of trouble? Probably not. Their balance sheet looks pretty good right now, but I mean, you see a massive drop in Bitcoin, you know how people are going to handle this. Some of these other CEOs. The other side I would say is like a lot of the announcements we're seeing. Yes, some are trying to follow Saylor's playbook, taking advantage of that volatility and issuing debt related to it for converts and preferreds and different things like that. But there's also even more announcements of just like your mom and pop places or like smaller companies that are like taking 5% of their corporate treasury and just allocating it to Bitcoin, which I think is a positive sign. It's more like how like an individual like you or I would add Bitcoin to our personal balance sheet rather than, levering up to get exposure to it.
Yeah, it's just, you see some like extreme instances that give you pause. I know there's like this Italian coffee company that has 6 shops that's raising, I think, $1 billion for their own Bitcoin treasury. And I'm having a really difficult time understanding how coffee beans can translate to $1 billion worth of Bitcoin holdings. But I guess we'll have to see how it plays out. These are new and unfounded times, and I guess only time will tell, as they say. But hang tight, James, because this next story I want to talk with you about is the man who started all this. Of course, we're talking about Michael Saylor and his corporate alter ego strategy. They are now the world's biggest publicly listed Bitcoin holder. At last count, they got around 607,000 BTC. And if TD Cowen analysts are right, that number could hit 900,000 by 2027. Which would mean Saylor's company controls 4.3% of all Bitcoin in existence. That, my friends, is not a strategy. That is called monetary conquest. Now, some critics say the company's stock, which trades at 72.6% premium over its Bitcoin net asset value, is dangerously inflated. That it's a speculative bubble, and that the only people buying are greater fools. But TD Cowen's Lance Vitanza and Jonathan Navarrete say those critics are, how do we put this, logically flawed.